Ladies and gentlemen, today we have an essential topic on our hands. The post-election euphoria gripping financial markets has finally hit a wall. Yes, even the Wall Street bulls who rode a wave of optimism following Trump's election victory are realizing that stock market rallies don't last forever. In this sharp turn of events, key risks are revealing how fragile this Trump trade is. While the initial buzz of tax cuts, deregulation, and fiscal stimulus sent markets soaring to record-breaking heights, we are now witnessing the inevitable hangover after the binge. Why, you ask? Because Jerome Powell, with his go-slow interest rate stance, has thrown a wet blanket over that euphoria, effectively telling investors, not so fast. Despite the wave of euphoria that pushed stocks up, buoyed by promises of business-friendly policies, tax cuts, deregulation, and fiscal stimulus under Trump, the Federal Reserve is the reality gut check that many investors seem to forget about. Contrary to expectations that his administration's business-boosting agenda would keep upward momentum in equities, Powell's deliberate and cautious approach to monetary policy has been the great equalizer, reminding everyone that rates are not going to come down as easily as many had hoped. The moment Powell signaled that the central bank wasn't in a rush to cut those interest rates in the face of a remarkably good economy, markets swiftly turned down. But here's where it really starts to pinch. Bond yields rose again, with the 10-year Treasury yield hitting a 4-month high. And when yields go up, stocks tend to go down because borrowing costs increase for corporations, squeezing their profit outlook. For context, over the past week, the S&P 500 shed 2%, and corporate bonds and commodities also slumped. Remarkably, it was the most significant cross-asset retreat we've seen in the past 13 months, a signal that market optimism was perhaps a little too stretched. Gone are the glory days of unfettered stock gains as inflation risks have prompted investors to rethink their bullish bets. Now, let's zoom out. Why does Powell matter so much, and what does this investor behavior signify? Simply put, inflation is again haunting markets like that annoying tune you can't shake off. Even with ample liquidity swirling through the economy, thanks to fiscal stimulus, rising inflation puts the brakes on growth prospects. Powell's caution stems from this very risk: push interest rates too low, too fast, and ballooning inflation will eat into the consumer's buying power, and no one wants to relive the 1970s. To make matters worse, we have another problem. The stock market itself is overvalued. Excessive optimism means that Wall Street expects nearly flawless execution from corporate America. But the truth? There's little room for error. One hiccup in the data, inflation rising too high, or growth slowing, and these sky-high valuations could come tumbling down. A Bloomberg model comparing S&P 500 earnings yields and 10-year Treasury inflation-adjusted rates makes it clear, valuations are more stretched today than at 88% of historical instances. We're in expensive territory, folks. Remember that markets climbed because of strong expectations around growth, profits, and deregulation. But lurking behind the scenes is the threat of inflation, which can pressure the Fed to keep rates higher than expected. As John Davey, Chief Investment Officer at Astoria Advisors, pointed out, the market is expensive. The speech by Powell effectively saying the Fed doesn't need to rush on rate cuts is why we're seeing this sell-off. A sobering reminder that when inflation creeps up, central bankers step in. The stock market isn't suffering alone either. Both corporate credit and commodities started showing signs of weakness. With the RPR Risk Parity ETF dropping 3.2%, seeing its worst one-week performance since October 2023, this wasn't just a bad week for stocks, it was a bad week for almost everything. Small caps, represented by the Russell 2000 index, dropped by 4%, enduring their worst week in 2 months as optimism about new fiscal policy lost steam. Even the Nasdaq 100, a tech darling boasting strong balance sheets, couldn't escape the turmoil, slumping amidst faltering sentiment ahead of major earnings. This brings us to the heart of the matter. The economy itself may still be showing consistent gains, but financial markets are forward-looking machines. When cracks start to emerge under the weight of inflation, those same cracks can swiftly expand across multiple asset classes. It's not simply about stocks, it's about a breakdown in confidence, one that ripples out into bonds, credit, and commodities alike. Interestingly, one of the most telling developments during this period is how institutional investors responded. As much as markets were reeling last week, we received news from Bank of America's latest survey: big money managers had raised their holdings in U.S. equities to an 11-year high. It makes sense. As Powell preaches patience, the continued strength of the U.S. economy is hard to ignore. Retail sales numbers are solid, inflation is firm but not out of control yet, and labor markets are resilient. But here's the paradox: everyone's rushing into stocks just as valuations are at all-time highs, and that's a signal the rally may be losing steam. Sentiment can turn quickly from euphoria to panic, and current market levels leave investors exposed to sudden sell-offs. Even so, a sustained rally might still be in the cards. Some heavy hitters on Wall Street, like JP Chase and Company's strategist Nikolaos Panagurtsoglou, see parallels between today and the immediate aftermath of Trump's win in 2016. Given that environment, they argue that the Trump trade might still have room to run, propped up by a strong dollar and resilient corporate earnings. JPM's equity strategists, led by Andrew Tyler, remain bullish, touting their view that stocks can climb even into year-end, buoyed by surprising economic strength. While stock markets faltered, a curious thing happened in the crypto world. Bitcoin, that ever-present speculative asset, extended its election week rally, rising more than 30%. But Thursday saw something unusual. Bitcoin tracking ETFs had their first outflows since the election, marking the beginning of a potential shift in sentiment. Part of Bitcoin's recent rise came from optimism about Trump's pro-digital asset stance and his vision for regulating crypto more favorably than past administrations ever did. However, even the earlier bounce in Bitcoin was supported by the same manic speculative behavior that boosted everything from small-cap stocks to AI-driven mega-caps. Meanwhile, the strength of the US dollar cannot be ignored either. Last week, the dollar hit a two-year high, rising for 7 consecutive weeks thanks in large part to the belief that Trump's protectionist policies would be dollar positive. This is a classic case of, buy the rumor, sell the news. Promises of pro-growth reforms and fiscal expansion have fueled dollar strength, even as traders wrestle with the long-term implications of potential inflation. In summary, ladies and gentlemen, we are witnessing the delicate unraveling of the massive post-election market rally. Winning bets on pro-business policies have to reckon with financial realities, and this week delivered a clear message: skyrocketing optimism meets the cold, hard floors of inflation and bond yields. With Fed Chair Powell standing firm on pausing interest rates, investors can no longer expect a free pass from monetary policy. Elevated valuations across the board, bond yields ticking higher, and inflation lurking near the Fed's targets all paint a picture of risks skewed to the downside. Yet, for all the doom and gloom, the larger takeaway shouldn't just be about volatility but the bigger paradigm shift underway. Fiscal policies will have a lasting impact, and the Fed is not short on ammunition to handle shocks. But what should keep both average investors and financial professionals awake at night is how these policies amplify long-term concerns about inflation, monetary control, and economic growth. So buckle up. The road ahead isn't going to be as smooth as we hoped. For now, the Trump trade is gasping for breath, but we haven't reached the end of the story just yet. Time will tell if continued fiscal hawkishness will derail markets completely, but one thing is clear: the days of riding high purely on hope are over. Let the retracement begin. Stay sharp, stay informed, because financial history